It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hi, I'm Esther Gulius, the tax lady from EG Tax, and we're here to talk taxes for an hour. About 5 or 6 times during the year, we do a special show where we don't take live phone-ins, and this is one of those weeks, and we're just going to chew up your emails, and I think you're going to find it interesting because you'll hear us say, if you do this, this is what it is. If you do this, this is what it is, and I think you'll learn that not only are taxes complicated, but the thought processes to make it deductible sometimes are very subjective. So we hope that you'll enjoy listening to the emails. I got Christopher Fabian, our Vice President, here.
Hello, Esther.
And Tiffany, our Vice President of Operations, here.
Hello.
And we're going to be talking taxes and emails. Next week, we're going to do a live phone-in again, but this week we're going to chew up those emails. So what do we got here?
I got D from Amherst. Yes, I did my own taxes in 12, and I've been getting those love letters you've been talking about. I called the software company, and they say I need to pay it. Would you look at the bills for me at no charge? I really would like a second opinion. Well, that's an easy question. I know the answer to that. It's yes, yes, yes. Don't pay it, and let us look at it.
Right.
Please.
I mean, the software company may not.
Right.
Well,
There'll be no
even
charge for us to
looked
look
what
at
it
the
was,
letter.
and that's part of what we do.
And I can't tell you 9.2, 3, 4 times out of 10 they're wrong. So, or part of it is wrong. So please,
and
give us a
that
call.
means you get these love letters that they just run a computer scan of everything.
Right.
And the computer scan might have said that you had, let's say, a W-2 that wasn't reported on your return. I had a client that came in and they said, well, this W-2 was in your Social Security number. And the taxpayer says, I haven't worked for that firm for 20 years. He said, but my brother works there. And do you know what happened with the software? They had gotten new software, and the computer accidentally picked up the brother's Social Security number and put it on the other brother's W-2.
Gosh.
So when his brother who works there did his
Right.
taxes, he did it, right? They put it on his return. But when the IRS ran the scan,
Yep.
they picked up just the Social Security number and sent my client a letter. So we called the company. The company said, oops. They sent a letter, corrected W-2, and he had gotten like this $25,000 bill from the IRS. So that's just part of what they do. Sometimes you sold stock or you didn't know you sold stock, but your broker said they moved it around. That's another word for we sold it.
Right.
And you didn't put it on your tax return. The IRS gets the notice that $100,000 worth of stock was sold. And what do they think?
That there was a zero basis and that you got the stock for free. And so they charge you capital gains on it. And
Like
you
a
didn't
$20,000 bill,
Yep,
right?
and you didn't include it. Yes.
But when we look at it, we say, oh, you had
Easy.
the $20,000 stock. Did somebody give it to you? No, I bought it. What did you pay for it? I paid $110,000. You mean you lost $10,000? You get a refund. So, I mean, that's what happens. That's the reality of those letters.
Right.
But they send you those letters like they're the gospel,
Yep.
right?
Yep.
Absolutely.
So please call us. Okay. What else we got?
Let's see. Danny writes in, EG Tax. I just recently helped out my church and built a garage and a shed for them. They paid for the materials, and I used my tools. They gave me a letter thanking me for my work and saying that they valued my labor at $18,000 that I can use on my taxes. I don't think this is right, but if I can use it, that would be awesome.
I was just doing a tax return the other day, and it's a middle-aged guy, and he owns a construction company, and he did some work for Habitat for Humanity, and he got the same letter. And unfortunately, you cannot write off the labor. It has to be tangible products that you gave, and so his time and the value of his labor of $18,000 is null and void.
Somebody's got to call Jimmy Carter and straighten him out.
Yeah.
Isn't he the Habitat for Humanity
Yeah,
guy?
yeah.
So now
No.
explain to them why you can't deduct it.
Go ahead, Chris.
You're volunteering. So volunteering, it's free. You're
You
doing
do the miles, right?
You can do the miles.
That's what I
if
did
you
for him.
bought any extra tools, your supplies, but your time is free.
Right, but the whole thing is here's the reason why it's not deductible is because you're not paying taxes on the 18. If I say to my clients, if you want to deduct the $18,000, it has to be income that's already been taxed.
Right,
So
right.
if we want to put the 18 in on line 7, then we can take the 18 as an itemized deduction.
not a good plan.
But that doesn't make any sense because if you don't itemize, right?
Right.
So
Right.
that's why. So your time is never deducted.
And I mean, if he got a letter saying thank you for your, the 18,000, I would almost call him up and say, I'm not getting a 1099 for this, am I?
Holy moly!
Because
Right.
that would be even worse.
Worse. Right. So that's why. Okay. What do we got here?
Let's see. Hannah writes in, I just got a job with a small company who doesn't withhold any taxes when they pay me. They say it's
What a
my
nice company.
Yes. They say it's my responsibility. My parents say that is not correct. I am in the office as a receptionist, and it's really nice to get the entire paycheck rather than one with taxes gone from it. Who's right, my parents or my boss?
Mom and
Do you
Dad.
wanna say something?
Mom and Dad are
Mommy and
right.
Daddy are always right.
Yes. It definitely sounds like they're paying her as a self-employed contractor, and that's not how she should be paid. So she is going to have to, unless get this straight, report everything on a Schedule C, subject her to self-employment tax. And so the truth is, the law is pretty clear on this. If the employer gives you a place where to work, an office, they set your schedule, they set when you're coming and going, and all those neat little things, you're considered an employee and not a self-employed
So what
person,
should she do,
sole
Chris?
proprietor.
Well,
Have a conversation with them.
yeah, first of all, have a conversation with her job and say, I need a W-2 because that's what it is, because they're getting away with not paying the payroll taxes, workman's comp, the unemployment. There's a lot of
The
different...
FICA.
Yep.
Right?
Yep.
So, see, the whole thing is when you're self-employed, you pay 15.3% on the bottom line in Social Security. If you're an employee, you pay half of that, 7.65%, and your employer pays 7.65%. Plus, your employer is paying New York State unemployment if you become unemployed. Plus, it's there's disability they have to provide for you. So there's all these other payroll taxes. Sure, your employer wants to save himself the insurance, the unemployment costs, the FICA, and so that's why he's paying you for it. And I'm just going to tell you flat out, it's illegal. And if your employer does not get the message, call New York State Unemployment, New York State Department of Labor, and you turn in your employer.
That's
and
right.
then I know what she's going to say. I'll lose my job.
Yeah.
But that's, because what's going to happen...
Come tax time. She's
And then
not
not
gonna
to
be happy.
mention how, let's say she does this for a long time, and she's going to end up with the burden of paying both ends, and it's just not right. And this guy, you're actually doing your employer a favor, quite frankly, because the state of New York is auditing people who are doing 1099s and should be putting people, because they will get a gigantic fine if New York State kind of trompses in there and finds out that they're doing that.
Yep.
And it's not hard. You can have, and that's part of what we do at our business, EG Tax Business Solutions. They can call us. Right. We'll help your employer, and we'll get him all straightened out so that he's good to go and he doesn't have any payroll taxes, right? Any payroll
Right,
penalty.
and you don't want to get shut down for not having workman's comp either.
Amen. That's for sure. Mm-hmm. Okay, I'm Esther Golias, the tax lady. We're going to take a short break. Join us on the other side. I'm Esther Golias, the tax lady from EG Tax. We broke for commercial, not for the news. News is coming up. So if you said, that doesn't sound like the news, it wasn't the news. We're talking taxes. We're talking emails. What do we have here, Chris? What's the next thing?
Lily writes in, I was told that when my child goes to college, my refund was going to go up by $2,500. When I did my tax return last year, my refund stayed the same. When I asked the preparer, she just said, I don't know. Can you please help me understand?
Well, since taxes are so complicated, all right. So first of all, if you paid for or charged for the higher education of your child that you claimed as a dependent on your tax return, then potentially, if your child was in college at least 25% of the time, then they would qualify for the AOTC, right?
Right.
But it all depends on how much they paid for tuition and books.
Right.
Because you get a 100% credit of the first
2,000.
And then
bucks
50%.
you pay, and 25%
25%
of the excess until it comes to $2,500. Okay, so if your kid was on a full scholarship, and all you paid for was room and board, you don't get anything.
Right. Or if she happened to make a lot of money, there's a phase out. And
or
so,
if you made a lot of money, but
Right.
probably the case is, I'm assuming that she didn't pay for anything.
Right. And then I was very scared when the preparer says, I don't know. You know, you want to have a second look and make sure it was done
That's
properly.
true, too. And, that's true. If your preparer said, well, I don't know, or they didn't maybe know that they could use the required books or supplies
Right.
that they could add, even though they were on a full scholarship, or maybe they didn't know that. Maybe you said that we borrowed all the money, and the preparer said, gee, we didn't think if you borrowed money you can take it. That would be wrong.
Right.
So,
right.
yeah, I'd have a second look. Good comment.
And then don't forget about the state college credit, too.
Right. I mean, there could also be maybe her income, she didn't have enough income to give her the $1,500 up top as the Pac-Man
And
credit.
all she has is
and
the
all she
balance.
has is the $1,000 refundable, but maybe the child turned 17 and still went to college at 17.
That's true. And she lost the
She
$1,000.
lost the $1,000 child tax credit.
Right.
So, I mean, there could be many
Or
different...
maybe she changed her withholding.
Yep.
Or maybe her income went up so that she lost part of her earned income credit. I mean, there's so many variables. So, but if you want to come into the office, we're not going to charge you to look at the return, and we'll explain what happened. We need actually 2 years returns. We need the 2013 and the 2012 so we can do the
Right.
whole comparison. Or maybe she had a child that left her. There's a ton of things that could have happened.
Right.
So...
Lots and lots.
But that's what happens when we're doing tax returns. Don't you see? Sometimes you'll be doing tax return. You'll say, "Okay, John and Mary, you're getting a $4,000 refund," and they look at you, and they say, "I thought we were going to get a bigger refund." So then you have to explain to them, "Well, last year your withholding on the same income was $10,000. This year, remember we told you to change your W-2 at work, your W-4 at work, so they gave you more at home. This year." All that they took out was $7,000, so your withholding's down $3,000. Oh, but it felt so much better to get a bigger refund.
Yeah, that's why I hate to keep going back to this, but I'm teaching a tax class, and my students are like, "But can't we just depend on the software?" I said, "Yeah, but you want to be able to explain it to the person, or if they call you on the phone and want an explanation, you want to understand the tax code.
You
know?
do, and you want to understand why it happened.
Right.
You don't want to be blindly just putting things in. I mean, when people are do-it-yourselfers, they don't know if it's right.
Right.
They just say, well, they didn't write me yet, or I got my money back. Well, mathematically correct is not correct necessarily.
Right. I did an amended return yesterday for somebody who used tax software, and he put in his mileage, but he didn't check the box, and so I got him $2,500 and $600 on the state.
that's great.
And so it's just garbage in, garbage out.
Right. Okay, what else we got?
I got Ron in Lockport. Esther, I recently came into some extra money doing some odds and ends for businesses around the corner from where I live. They are paying me $200 cash weekly. When I asked them about my taxes, they said, don't worry about it. Do I have to claim it or not? Can I get in trouble? Ron from Lockport.
Sounds just like the other girl,
What other, like,
Hannah.
What you mean, Hannah? But she's not getting paid cash.
Well,
Yeah, but
Right.
the answer is you have to claim the money. It doesn't matter how much you make. Doesn't matter what the employer says. You have to claim the money, and you can get in trouble if you don't claim it. So
Right,
you
but
have to claim.
here's the thing. if he's doing odd jobs, this might be his second job. He's going from the first job to the second job. The travel to get there would be deductible. If he's putting his tools and placing them into service,
Right. Yep.
the tools are going to be deductible. And
Cell phone use.
so you're ending up with maybe $10,000 in income on the left-hand side, but your expenses might be $8,000.
Right.
Right? And so you end up with only $2,000 that's taxable, and then it's correct.
Right. It goes on a Schedule C run, and Esther's right. Make sure you money in, money out, so you keep track of all those expenses because those will offset that money that you're getting, and so definitely goes on a Schedule C.
And we see that all the time. You don't need to know about that income. Yeah, we need to know about all your income because they do. If you get audited, they look at your bank accounts. They look at everything, and
I'll tell taxpayers. You could have gone to anybody to have somebody cheat for you, right? I mean, you can just stop some guy in a corner. You can sit home and cheat yourself. But if you're coming to a professional who really's job is to make sure they not only get you the best refund, pay the least taxes, but keep you out of trouble. Because I'll say to somebody, is it really worth it to put an extra $1,000 in write-offs on your return? You're in the 10% brackets. It's saving you $100. So for $100, you would risk this? It's just not worth it.
Yep. You sort of put pen to paper and give it an answer.
Right,
a figure.
because you say the bottom line is
not worth it.
$1,000 times 10% is $100. That's
worth it.
That's all you're saving. It's not worth it.
No,
Not at
the
all.
Wonder
stress,
if
the
some guys get out of a black car with a trench coat and not come to your door. You go, oh no, it could be the Internal Revenue Service, and really it's just John Belushi. Okay, go ahead. All right.
I got Tom. He says, "Hey gang, the other night I got extremely lucky at the casino and I won $10,000. How bad is that going to hurt me? I receive a pension of approximately 20, Social Security of $18,000 a year. How much should I save?" And so I would like to know if he's married.
Doesn't
Why?
say. Tell you.
But we're going to go with the single.
Well, I mean, but the bottom line is, what does that $10,000
Oh,
do
it's
to
going to
his
make
Social Security?
More of that Social Security taxable, and
Even if he lost the 10,
right.
yep.
Right.
Effectively, the 10 is not going to make the. If he won the 10 at the casino, he can. That's on line 21 income.
Right.
Then he can take the $10,000 as an itemized deduction, right?
If he's spent that
But if
much.
he doesn't itemize, because he doesn't have enough to itemize, it's basically not going to be deductible. But what happens to his Social Security?
It becomes
Makes it
so much
85% of it
Taxable.
taxable.
5%. Oh,
So the Social Security that might not have been taxable becomes taxable because of the gambling.
Yep.
So it's just not a good thing. I always tell seniors, please don't gamble.
no,
Another thing I hate is
Or-
seniors that gamble.
How about when they come in and they go, I won that $1,500 and here's my win-loss statement, and the wins for the year are $53,000, and you have to put the $53,000 on the return, and they have a heart attack?
I know.
there was lots
Just
of them
terrible.
not reportable.
Just
they
terrible.
think. Yes.
Okay, what else we got?
Carl writes in, help! I know I'm in trouble. I just sold 2 rental homes that I had for 20 plus years. I bought them for $75,000 each and sold them for $125,000. What am I looking at for taxes? Is there anything I can still do?
Did he sell the 2 for $125 or $125 a piece?
I would say $125 a piece.
Okay, so his gain is going to be $250 minus
$150.
So he's got a $50,000 gain per property.
right.
That's not counting into depreciation.
Right, that's what I said. How many years did he have them?
Over 20 years.
All right, so it's probably mostly written off. So what happens when you buy rental property, they make you take a deduction every year on your Schedule E. I'm assuming he isn't making more than $150,000. If he had income over $150,000, those would have been suspended
Rainy
losses,
day, right.
right?
Yep.
But assuming his income wasn't over $150,000 and he did take the depreciation like he was supposed to do every year, it's reducing the cost basis. So as far as the IRS is concerned, you really didn't pay $150,000. At the end, what you have left might be $30,000. So that would mean that 30 and 30 is 60. From your $250,000, you're going to have a $190,000 gain. Yeah. So
Yeah,
And
it's-
depending upon how long ago it was, if any of it was accelerated, most of it's going to be recaptured as capital gain.
And
long
then he
term.
asked if there was anything you could do. I was thinking of a like-kind exchange, but it's too. Looks like it's done.
Too late,
Too late.
baby,
It has
now.
to be. You have to do it with an exchange agent, and it has to be within the certain time period, within the parameters guidance.
So you could have done a tax-free exchange,
Right,
a
right,
tax-deferred
right,
exchange,
yeah.
actually. But it sounds like you didn't. So what I'd suggest you do is call us. We'll tell you how much money you're going to have to pay on the 15th of April to the federal and the state. Now the federal's going to cut you a break,
Right.
right? Because
Reduce
if his
the-
income's in the low enough, it's only going to be at 10%. So, but the state is not going to cut him a break at all.
No. But also, too, depending if he itemizes or not, if he does, he may want to pay New York State now
Upfront, right?
by the end of the year to get more of an itemized deduction on his federal return to save maybe a couple $1,000, $4,000 on.
Well, that
so
helps.
That's called tax planning.
That helps.
Yeah, now he wants to do tax planning. I mean, I love that question, especially during tax season. Is there anything else I still can do?
Yeah.
Gets
And
busy.
Well, and then if he has wages, and he's
Yep.
he could put money into an IRA, that would help.
Or
that kind of
load
stuff.
up his 401k
1K,
at work,
right. So you still have time before the end of the year. We'll help you as much as we can, but it's better to call us before you close.
Yep.
Before you close, because then we really can help you. It's a little tough after the wolf is at the door. It's a little tough.
Right.
All right, what do we got? A quick one before the news?
I got Alice. What is the difference between a credit and adjustment? My coworkers say adjustments are because it comes right off of your income. I said always take the credit because I remember listening to your show. What is going to have to buy lunch? Who's going to have to buy lunch? Alice.
Okay, so credit is better.
Right.
A credit is better than
Right.
an adjustment
Right.
because an adjustment is multiplied by your tax bracket. If you're in the 10% tax bracket and you got a $4,000 adjustment, it saves you $400. If you have a $2,000 credit, you get $2,000 in your pocket, or it reduces the liability by $2,000.
Right.
So I would rather get 100% than a percentage of 100%.
So Alice was right. They're going to buy you
Buy
lunch.
you lunch, Alice. You're going to buy you lunch. We're going to break right now for news. I'm Esther Gulius, the tax lady from EG Tax. We'll see you on the other side. Hi, I'm Esther Gulius, the tax lady from EG Tax, and we're doing the show again a little differently. We're just not taking live phone calls. We will next Saturday. But we're answering your emails, and you get to hear our brains work. So a lot of people enjoy this, too. So I'm joined in studio with Chris Fabian, Tiffany Fabian, and they're going to be telling us what's one of the emails. So what are we ready?
We got Chuck.
Chuck.
He says, EG Tax, I started a new business, and everybody's telling me I need to do a LLC. I was thinking of incorporating. What is the difference? Do I really have to do one of these, or can I just do a DBA?
You can do whatever you'd like. I mean, you can
Right.
do all right. So let's explain the different business entities. All right. So you for sure have a business now. A DBA is doing business as. You don't even have to do a DBA. This is Chuck, right?
Right.
Chuck.
So if your name is Chuck Smith, you can take checks in the name of Chuck Smith. That would mean that the business can be called Chuck Smith,
Right.
and you don't have to do a DBA. However, if Chuck Smith is doing business as Smith's Towing, and he's going to take checks in the name of Smith's Towing, you have to go
DBA.
down to Erie County or Niagara County and register for a DBA. And so that gives the bank, that way, if they're suing Chuck's or Smith's Towing, they know who to sue.
Right.
Because they want to sue Chuck Smith, and they go to the records and they say, who is Smith's Towing? Oh, it's Chuck Smith, so that's who we sue. All right? So that's a DBA, and basically you're going to put all your income in and all your expenses. You're going to pay taxes on the bottom line and your own FICA, right?
Right.
Now, what is an LLC?
An LLC,
Limited Liability Corporation.
limited liability company.
Company. I always do that.
That's all right. But
That
it
was
was
so nice of you. You said that.
All right.
It was originally designed to be a partnership, but with protection. So, like you were mentioning, a lawsuit. If it was done through an LLC, the only person that could get sued if something happened while you were towing would be the LLC. They couldn't come after your personal assets. So that sounds really good. For tax purposes, if you are a single owner LLC, like a lot of LLCs are out there, it's still for tax purposes treated as self-employment. So it's still going to go on your Schedule C. Income expenses still have self-employment tax.
But the only thing they can sue is the assets of the limited liability company.
Correct.
Correct? So it's protection.
Correct.
So if you are a DBA who would like some protection, right?
Yep.
There's some of you that don't want protection, but if you want protection, then you would do the LLC, and it's really not expensive to do. I mean, what's it, $125 to?
No, an LLC is actually $1,500.
What?
After
Legal
because
zoom,
it's
that?
because
To
you have
become an
to
LLC?
become an LLC because you have to pay New York State, but then you also have to advertise yourself that you're an LLC in a daily paper, a weekly paper, and a monthly paper. And that's where the extra cost comes
Really?
in. Yep.
Wow.
So an LLC, okay, the insurance protection, what you want to look at is what you could be sued for. Is it worth it? Or can I just carry a $2 million rider?
Policy, right? Insurance
Umbrella
policy.
policy. Yep.
Yeah. Okay, so that's two types of business entities. The third kind would be a
Corporation.
And there's basically two kinds of corporation.
Yep.
There's an S corp and a C corp.
Yep.
Right.
All right. So a C corp,
Start off as a
all
C corp.
corporations start off as a C corp,
Make
and
an
a C corp, it's just the business. It's just basically Smith's Towing becomes Smith's Towing Incorporated.
Right.
Now, the net profit for Smith's Towing on a C corp has to. The bottom line. Smith's Towing Incorporated has to pay income taxes on that.
Right.
And if Chuck wants to get paid, he's got to get a W-2, right?
Right.
So he's going to get a W-2. Smith's Towing Incorporated is going to pay the FICA, all the payroll taxes, da 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 da. And so Mr. Smith's going to get a W-2, which is an expense to the corporation.
Right.
But let's say that his W-2 is $25,000, and there's a net profit of $50,000. So the bottom line, the $25,000 goes to Mr. Smith as a dividend.
Right.
Right?
Yep.
And so that becomes a taxable event. So he's
Right.
got the $25,000 W-2
Right.
and the $25,000 dividends. But the corporation is going to pay taxes on the $25,000 dividends as well.
Right.
So that's why
Double.
they call a C Corp double taxation.
Right. Right. And
But there's a loophole.
there is.
So Chuck can make an election.
To become
He
an
can
S
sit
corp.
there and say, I would rather be an S Corp. And what's the benefit of the S Corp, Chris?
The S Corp is that the money is your money and you don't have to do the dividends. So you're going to pay taxes, ordinary income on that $25,000,
And it'll only be taxed.
and it only's taxed once.
Once.
Not on the corporate level, but on the personal level.
You know, they say the best way is to actually learn and live it and experience it. Well, I've had several clients who've gotten those dividends. One who has a placement agency, and another one who has a auto supply store. And they've gotten those dividends, and they've actually cried in my office. And I guess that's how I learned. It's just ingrained in me about the C Corp because I've watched them pay double taxation, and I sort of cry with them.
But didn't you make the election
Oh, yes,
to change
they
it?
talked to Mr. Fabian.
All right, because the whole thing is nothing. You can always do the 2553
Correct.
and the CT6,
Right.
and make an election to stop being double taxed,
Right.
and become a small business corporation, provided you don't have more than 35 shareholders,
And you're not a
people
U-
are not
and you are a US
from
citizen.
Canada and all that
Right.
stuff. You're like a normal thing,
Right.
and you don't mind going to a calendar year versus a fiscal year, because that's the other thing. A lot of times CPAs will set you up because they love doing the fiscal year thing, but that makes you pay double taxation. The other thing is, what if you lose money if you're a C corp?
If you're a C Corp, it just stays out there.
It just adjusts the basis, right?
Yep.
But what if you lose money and you're a subchapter S?
Okay,
Well, then it would come off your wages or your other income, and it would
It's
net out.
deductible,
Yep.
right? So if I don't know how we even got on this. This is what I love about doing these things. But
Chuck.
if you're out there and you have a C corp, you need to call us,
Right.
because we're gonna, if we can, and most of you can, we're gonna move you from a C corp to a subchapter S, and you're gonna start saving some money. bottom line.
I mean, I know I've had people this summer come in and they're like, but isn't an S corp? Aren't there a lot of laws you have to follow? And I said, you mean the law of having a meeting? And they go, well, yeah. I said, well, do you ever go to dinner? They go, yeah. I said, well, all you have to do is you sit there on one side of the table and you go, hi, we're going to talk about this. Any questions? Go to the other side. I would like to get reimbursed for mileage. Go back to the other side of the table. Okay, it's settled. You're going to get reimbursed mileage.
You're talking to yourself.
You're talking to yourself.
Doesn't a C Corp have to do? Do they have to do a meeting?
Well, yeah.
Yeah.
I mean,
But
part of what you have to do is come up with resolutions of corporation. Whatever you decided, you need to put it in your corporate minute books.
Yeah.
You know, but it's just
It's not hard at all.
not hard. I mean, to save the money, it's worth it.
And also, if he's starting a business, not only the income tax, let's talk about sales tax. How many people have we had in our office
my God.
that come in and, I started a business, and they're 3 years old and they've never paid sales tax,
Right.
and it's
I
something.
think we just helped a lady with that not long ago.
Yep.
Lovely lady, you know, and so we fixed her tax return. She paid the New York State, and you know, but it's not good. I'm telling you, when these people come to your door and they send you these bills, and you can't say, "Gee, I didn't know," because that's no excuse.
Ignorance.
And so, Chris, it costs like $1,500 for a LLC. How much to set up a
It
C
actually
Corp?
doesn't cost that much. He's
But
saying the
the
related
advertising.
expenses.
How much for a C Corp?
About $300.
Right. And actually, you can do it yourself online. So if you're somebody that wants to use LegalZoom, or we always use
BizFilings.
BizFilings.com, it's really not that
very
expensive.
So
right? But
I
the
would
important
think
thing
Chuck
is, you also, when you get those little books, if you are doing it online, you can come in and we'll do the 2553 for you in the CT6, and so and we'll do the SS4 to get you your EIN number, so that you're all cool, and that's part of what EG Tax Business Solutions does for you too.
And bookkeeping. Keep talking about business solutions. Do your books. You have to do your books.
And save your
on
receipts.
On a regular basis. It's not, it's tax time, I better take out my
balance your bank account too. And what did we discover this morning, Chris?
switched merchant services and
We had $13,000
of missing
worth
deposits of credit
worth
cards.
of credit cards that didn't get posted to our account last month. So I mean, ignorance is not bliss. I'm going to tell you.
No.
So that's from Auntie Esther and the crew here. All right, what else
I
we got?
Christopher. It says, my wife's Social Security was finally approved, applied for in March of 2010. Out of the settlement, the lawyer, this must be a disability, is getting a nice portion of it. Is there any deductibility of that? Is the amount we get taxable?
Okay, so what happens in that situation?
Well, since you're getting a lump sum, first of all, you're going to get a check for 10, 11, 12, and 13. So you're talking 4 tax years involved. So the first thing, yes, Social Security can be taxable. Let's deal with that aspect of it first. So since it's a lump sum covering over 4 years, the government's going to let you do what's called an LSE, a lump sum election, where you can go back and look at those 4 years that it covered to see if any of it would be taxable, and if so, how much, and it would all, then the taxability would all go on your 2013 return. So if you do have taxable Social Security, we'll say of this one, we'll say $7,000, and the lawyer fee was $10,000, you're only allowed to write off up to the taxable amount. So in this case, it would be $7,000. So,
assuming it's into the gross.
And yes.
In the gross, right.
So, I mean, there's a lot there. I know we said it fast. We're coming up to a break. We'll tackle more into it.
All right, that's what we're going to do. I'm Esther Gilius, the tax lady. We're going to take a short break, and we'll join you on the other side. I'm Esther Gilius, the tax lady from EG Tax. And all right, we're talking about Social Security. It's our last break here, our last quarter before the show is over. We're talking about taxable Social Security. This lady got a lump sum distribution. Right?
Right. And she needed a lawyer, so we were saying the lawyer fees up to the taxable point of the Social Security is deductible on the schedule.
If you're an itemized,
Yep.
If you're an itemizer.
Itemized deductions are subject to 2%.
Right.
So that can help. Also, maybe she was on workman's comp during that time
As
frame.
workers' comp
Now
offset.
they say, wait, you should have been on Social Security. You have to pay back the workman's comp, so you go from tax-free income to taxable income. that workman's comp could also be part of your Schedule A, subject to 2% as an itemized deduction, too. So they're going to give it, and they're going to take it away, but then you could maybe reduce the taketh by your itemized deductions.
Right. And the most it can be taxable is 85%.
Right.
And if you're doing a lump sum election, it might not even be near that much.
Right. And then the good news is Social Security is tax-free on the state of New York, so you want to
and that's why those expenses are, you have to remember to back off those expenses if you are an itemizer on New York State, because all the Social Security is tax-free.
Right.
Right?
Oh, that's right. That's
Yep.
right. How many people miss that?
Yeah. And, but, speaking of Social Security, how about, how much money can I make before I have to pay back my Social Security? That's another popular question
You
we
mean
get.
when you're
when
under
you're
the age of
between 62 and 66.
Full retirement age.
Yep.
Right.
Yep.
It's like $14,125.
Right. And it's different than the paying tax on Social Security. People get those two confused, thinking we do both. Well,
Right.
we don't.
So let's say you're on Social Security that you got at age 62, and you were working making $40,000. If that was the case, they wouldn't even give you the
your
Social Security because you have to pay back $1 for every $2 that you make over that $14,000 threshold. So that would, but once you're age 66, you can make as much as you want. So if you're somebody that, but it still may be taxable. But if you're someone between the age of 62 and 66 and you're working, you have to realize you're going to pay back Social Security $1 for every $2 you make over that $14,000 threshold.
Right.
So if you're making $18,000, effectively you're going to give them back $2,000
Yep.
of your Social Security.
Yep.
And it may be taxable as well.
Sounds like a tax planning situation.
It is totally
Yeah.
tax planning.
Totally.
Totally.
Okay, what else we got here, guys?
Monica, this says, tax lady, I'm working for a man who pays me under the table, which amounts to be about $25,000 a year. I get tax free. My girlfriend told me that I'm shooting myself in the foot because I can't get such a big tax credit. I think I'm better off because I'm not paying the taxes. What could she be talking about? I've been doing this for 8 years. I have 2 kids. I'm single and divorced.
So you know what she's doing. Her girlfriend's getting an earned
Earned
income
income
credit.
credit. Right.
Because if this lady thinks she's so smart, and how many people do we see? They think they're so smart
Right.
because they're they think that they're really getting the IRS because they're not paying taxes. In
doesn't
her
get the child
situation,
tax
not
credit.
only will she not pay taxes if she claimed it,
Right.
she would get money from them because she gets an earned income
Yep.
credit.
And she's
right?
not paying into Social Security.
And she's not paying
Right.
into Social
So the
Security.
earned income credit would pay her Social Security bill, and there would be the additional tax. She would still have a refund coming.
She is
So-
shooting herself in the foot. Just want to add that.
Yeah. Is that Monica you said her
Yeah.
name?
It's Monica.
Okay, Monica, listen to me. Okay. There is something in the tax law that's called the earned income credit. It's specifically for parents with children that live with them, okay?
Low-income parents.
Low-income parents. And really it's around 42,000, so not so low income. So because you have children in your home and you have wages, the federal government wants to give you a refund and the state of New York of over $4,000 based upon your income. All right, you don't pay it in; they want to give you the money. But if you never claim the money, you don't get the refund. Now, here's the really great news: on $25,000, you wouldn't have paid income taxes anyway.
Right.
So, over the last 10 years, you probably have cost yourself $40,000 or $50,000 in refunds that you didn't get.
And so I would come in and do those 3 tax years.
Well, I guess I would just go and talk to my
Your
boss.
employer,
And the boss, because he's paying her under the table, can he deduct what he's paying her?
Absolutely
no.
not.
So the boss paid income taxes on your $25,000. You didn't get the earned income credit. Nobody's paying into Social Security for you. So when you're old and feeble, and you go to Social Security, if you haven't paid in, who's not getting Social Security? You.
Yep.
Oh,
I always look at it too, that if someone's willing,
it makes me crazy.
if someone's willing to pay someone, well, like especially this amount, $25,000 under the table,
Right.
how much income are they not claiming themselves?
You mean the boss?
The boss himself.
Well, it
you know?
looks like
Care about
somebody
Monica.
needs a visit from the
IRS.
IRS.
Yep. But yeah, Monica, you're right, Tiff.
Oh.
You know, right now we're dealing
Just
with
care about
Monica,
I feel so bad for Monica, but we have good news for Monica.
Right.
What can we do for Monica?
We can we can do those last 3 years. We can do 11, 12, and 13's tax
We
return.
can blow in her employer.
Right, because
Actually, we should talk to her employer.
Right, because really it shouldn't go on a Schedule C.
No, it shouldn't. She can do the form where
It shouldn't go on
the
a Schedule C.
FICA portion. She's got to
Yep.
pay her half.
Right.
But the FICA portion, you basically fill out a form that says, I'm not subject to
Right.
the second half of
Right.
the FICA because I'm working for an employer. This is the employer's
Yep.
name.
Yeah.
And now, all right, but here's a horse of a different color. I mean, what happens to her because she never filed? Because she could file all those tax returns, which she's not going to get refunds. for.
Right.
At least that makes her not fraudulent.
Right. And which is good, and I'm not sure if it would give her credit for the Social Security because nothing was paid, but because no refunds were ever issued.
Well, maybe,
that's
but
something.
the employer's in big trouble.
Yep.
Because he has to pay all the Social Security, so he would fund her all of that.
Yep.
You know.
Why
So-
would you? Gosh.
But
just thinking
and
about
if
the
you're
employer.
listening and you're in that kind of a situation, don't think that you have been so smart that you haven't been claiming the income because tax laws are so complicated. There's all kinds of social programs built into the tax law. I'm going to tell you there are, and some of the people that really think that they're pulling the wool over the IRS's eyes, they really are just like the lady says, shooting themselves in the foot.
Yeah, I mean, I've seen people somebody's 80 years old and they're still working because they can't collect Social Security because for 30 years they worked under the table. I mean, and the kids go, I yelled at my dad all the time, and there's nothing.
You know,
we can-
especially some of the old timers, you know, and people that I've met over the years who, you know, they think that the IRS is bad and the federal government's bad, and so they don't really want to become part of the
Right.
system. Once you explain everything to them, say, all right, let me just show you here, because I wouldn't do the tax return anyway without them claiming it. But when I show them, by doing it the right way, they get a refund, and they go, how can that be? Because the law has it in the system that if you have wages and you have children at home, and even if you don't, and a lot of people don't even know if they're
the
before
age of
normal
60.
retirement age, and they're working, and they think, oh, I'm working under the table, so it doesn't affect my tax return. They would get an earned income credit too, even without children.
Right.
Yep.
So.
And they're still paying into Social Security. It doesn't matter what age you are.
I mean, and even if she is truly self-employed, say she's a nanny, or she watches this person's kids in her house, she has the office and home, she has the toys, she has all these expenses
Right.
to bring that income down. So really, the tax is going to be hardly anything.
Well,
after
I
the
will
earn-
tell you, with 2 kids and $25,000 income, even offsetting it by full Social Security, she's still going to end up with a couple $1,000 refund.
Yep.
Okay. Anything else?
We have Mark writes in, I have 6 rental properties that I would like to sell. I've had them for nearly 30 years now. What is the best way to unload them without paying a ton in taxes?
I think we talked about
We
this.
sorta
earlier.
did, yep.
Okay, so
slowly. I
it's-
wouldn't do all 6
all right,
in
so
one year.
the best way he can do it, if he doesn't mind staying in the
Business.
rental business, would be a tax deferred exchange. I know people call it tax free exchange, but it really isn't, because it really adjusts the basis, and at some point in time
You're going to pay
you're going to
tax.
pay the taxes. Not if you die, though. If
Right.
you're really
Defer,
lucky
defer,
and
die.
Dying is the best way out. But I mean, that is the best way. But you can do a tax deferred exchange, which basically means those 6 properties are packaged and given to an exchanger, and they're effectively sold. You have to identify another piece of investment property. So let's say you want to go to Florida. So you got your 6 pieces of property in Buffalo. You go to Florida, and you see this great
3 condos.
3 or maybe just a one. Maybe you just want to buy one
Yep.
condo. So the house in Florida is worth $500,000. Maybe your 6 here are worth $500,000. You sell them. They go to an exchanger. The exchanger then takes the title for a minute and gives you the title to the place in Florida. Sells this and gives it to the person's buying the houses here. You basically don't pay any. If you get no money, it just. You know, you aren't taking any money. then the entire gain is deferred into your your new place in
Right.
Florida.
And it does.
You go on.
Right, and it doesn't have to be like, we'll say Esther has the properties here, Tiff has the property in Florida. It doesn't mean Tiff's getting the properties in Florida and Esther's getting the property or whatever. It's different people doing different things.
But the exchanger is the common
Correct.
denominator. I know locally here, Russ Gullo is a great exchanger, and it completely saves you paying the tax liability on a ton of money. So that would be one. Second thing you could do is sell it on an installment sale.
Yep.
Right? He holds the mortgage. The only thing that's going to be taxable is the percentage of gain, which in this case is going to be 100%.
Yeah.
It will be 100% of the principal he gets over the period of time that he gets the mortgage. Right? So that's the second thing. Third thing is, we said die. The first thing is die, exchange, do the exchange. Third thing is installments, and then the fourth thing is just holding on to it, or you can gift them to your children.
Yep.
But just
they'll have no basis, and they'll eventually have to pay taxes on it.
And one of the smartest things is that you're asking now is planning
before you do it, and
look at your choices.
And believe me,
your
the
options.
tax deferred exchange is not hard to do, and it really sounds more complicated. But if you don't mind staying in the rental business, it'll really work for you. Right. Okay. Well, next week we'll be back in studio again here, and we'll be answering your tax questions during the week. Though, love letters, questions, you want to go shopping, wonder if what you should do, Christmas shopping, whatever, give us a call because we will help you. There's no charge. We really want to be your advocate. We're on your side. You can hear we're passionate about your tax situation. Our phone number at the office, 632-7886, egtax.com. Until next week, I'm Esther Gulius, Christopher Fabian, Tiffany Fabian. Have a great week. Bye-bye.